Howdy, Jacob here. Today we're looking at Agilent Technologies, company one in our generic stock screener in the life sciences tools and services industry, 40.9 billion market cap, a little bit higher enterprise value, 33 on the PE currently. Return on invested capital has historically been low to mid double digits, so still fairly impressive. Growth is pretty small in the low to mid single digits, but we are seeing an increase on both gross margin and operating margin side. So very positive signs there. Earnings per share growth well above revenue, another positive. Balance sheet shows $1.6 billion in cash-like products with zero short-term debt and 2.7 billion long-term debt. So that 2.7 billion long-term debt is just about 2 years, their 5-year average free cash flow. So no concern on the debt side. Their use of cash is very heavy on the share repurchases. We're probably seeing about a $1.3, $1.2 billion, let's say $1.2 billion 5-year average free cash flow. I would say about 50% is going to share repurchases, 25 to 30% dividends, with the remaining about 25% in acquisitions. They've reinvested a little bit back in themselves, but not substantially. So although they have this higher return on invested capital, they're not necessarily getting that return on invested capital. And also it is inflated due to their share repurchases. Company's been around since 1999. Okay, looks like they focus solutions to life sciences, diagnostics, and applied chemical markets worldwide. Pretty high market cap already, 40 billion market cap for a company that's 25 years old. So good for them. I think we're ready to start making some assumptions here. Hopefully that's zoomed in a good amount. Oh, yeah, 160. Okay. So hopefully you can see this fairly well. Their revenue growth, I'm going to stick with mid-single digits. I think pretty much market average. I think their growth will be relatively in line. And again, return on invested capital is a little higher, but they're just giving majority back through share purchases and dividends and then making acquisitions. The margin side, it has been growing, and I do like that free cash flow is a little bit higher. So maybe we'll do 17, 18, and share repurchases, 41, 410 million. Stock-based compensation, look at about 420 million is about 1%. So that means about 600 million would be about 1.5%. I feel pretty good about that. That's about 50% of their free cash flow. And then their dividend, currently paying out about 25%, has room to grow. Historically, it's actually going down. Let's increase that with our revenue growth. And this, again, leaves about 25% of their free cash flow, 20 to 25% available for acquisitions that are hopefully making the company more efficient, reinvesting back in themselves, and then paying down debt, if all else. And so we get to a price that I haven't done that yet. So it gets to a price that needs to fall. I don't know why I did not just grab all of it. Price needs to fall 6-9% before we get the return we're looking for. Again, high level makes sense. 33 PE currently. I'm saying it goes down to 16, right? Maybe a tiny bit above the historical average. And the margins are pretty much in line with what it is, just 5% growth in relation to my 15% discount rate. So no surprise there. I think this is a fantastic company. I don't think they're reinvesting a whole lot back in themselves, but I do think they're giving a good amount of money back to their shareholders. This is just going to be something I want at a cheaper price. So I do hope you enjoy the video and have a great rest of your day. Thank you.